Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. A straddle is an option strategy that involves a combination of a call and put option that have the same strike price and expiration date on the same underlying. A trader purchasing a straddle is expecting a significant move in a stock's price, but is unsure about whether the stock price will move up or down. The strategy will be profitable if the stock price either rises or falls from the strike price by more than the total premium paid. It would also benefit from increases in implied volatility. If a trader is selling a straddle, then the exact opposite is true. The trader does not expect the stock to move significantly in either direction. The position would profit from the passage of time and decline in implied volatility. Finally, a straddle can provide a trader with meaningful clues about the other traders think in the market about the stock. It can help determine the type of volatility the market is expecting from a stock. It can also give an indication of the expected range for a stock between the current date and expiration date of that straddle. For example, a $100 stock that has an at-the-money straddle price of $10 with a week to go until expiration means the market is expecting the stock to move up or down 10% over the next week. Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. A strangle is an option strategy that involves simultaneously holding a position in a call and put option with different strike prices, but the same expiration date on the same underlying. A strangle typically will consist of out-of-the-money options. If created using in-the-money options, it is referred to as the gut strangle, but this strategy is less commonly used. A trader purchasing a strangle is expecting large price movement in the underlying asset. The strategy has large profit potential if it moves beyond either the upside or downside break-even prices. For an options contract, the break-even is the point at which the position will make or lose money. Ultimately, the risk of the long strangle is limited to the premium paid for the two options. On the other hand, a trader can sell a strangle, which is considered a neutral strategy with limited profit potential. If the underlying stock is trading in between the two strikes at expiration, then the short strangle will reach maximum profit. However, if it makes a large move outside of the break-evens, then the strategy could result in substantial or even infinite losses.
Hi, I'm Russell Rhoads, Head of Research and Consulting for EQ Derivatives and a clinical professor of finance at the Kelley School of Business at Indiana University. One of the topics that I often find myself explaining is VIX, and it's been a core part of my career to explain VIX, especially to folks that think VIX is giving us an idea of current volatility. VIX is actually a measure that tells us how much volatility the market is expecting over the next 30 days. It is a forward-looking measure, which makes it a wonderful tool to kind of get into the mind of the market. Now, it currently in the fall of 2021, it's really not taking a whole lot for VIX to spike up when we get a small sell-off in the S&P 500. And I think that's an indication that market participants are pretty nervous about the direction of stocks. Also, the VIX curve is something that you should always pay very close attention to. It gives you an idea of how much of a buffer sellers of VIX futures are demanding to take on short volatility positions. And again, that curve is pretty darn steep going into the last quarter of 2021. One of the more interesting things with respect to how institutions use volatility indexes and volatility futures is typically they will be consistently short volatility, often putting on short positions with VIX futures. And one of the interesting things that came about with the market sell-off in March of 2020, we actually did not see the institutions go from net short to net long VIX futures as they had during volatility events in the past. So I think institutions have become kind of conditioned to take in stride volatility spikes, and if anything, maybe put on extra short positions when we start to see volatility in the form of VIX move higher.